we're talking about money. So hopefully you guys are all here looking for money. We've got a couple stud money guys here to talk to us about what they do and how they can help us in funding our deals and projects. And so super exciting. We'll go ahead and roll through. Anybody want to talk about what GRID is, gentlemen? Aaron?
Somebody asked me this question the other day. What does GRID stand for? I don't even know. But it's a group of investors that come together every month and talk about real estate opportunities or other investment opportunities all the way down the line from, funding all the way to fix and flip and wholesaling and all kinds of stuff. But it's a free entertainment, right? Because real estate is entertainment to all of us, aren't they?
Absolutely. Yeah, we're trying to build a community. We're trying to build a network. We're trying to share resources, opportunities. And the more people we can pack into this room, we got a big-ass room here. We encourage you guys to invite people out. More people, the more opportunities, the more resources we have at our disposal. So please bring some people with you. Thank you for being here. GRID is here in the Shenandoah Valley. We host it here in Front Royal. But GRID is expanding also across the country. We've got like a new chapter, it seems like every week popping up. We got Chicago, we got Orlando, we got Austin, Harrisonburg, getting ready to kick off. So if you guys are interested in doing deals in other markets, like you've got a network, you're connected, it's all free. Like just ask us, hey, do we have people in wherever, whatever market you're interested in? This is like, it's not just here, it's spreading across the country. So just keep that in mind when you guys are finding opportunities or looking for opportunities in other markets, or you need resources in other markets. Likely we know people in those markets. So we're going to do some quick intros of ourselves. Then we might pick on a couple people in the crowd. Just tell us a little bit about yourself. We'll introduce our guests, and then we'll get into today's topic. Yes, go ahead.
Cool.
Aaron?
I am Aaron Kavanaugh. I am a real estate agent. Keeping me away from everybody. I'm just kidding. I focus in on the Shenandoah Valley. I live in Berryville, but my target market is short-term rentals. So we have a little group called Stream that helps with education. That's this part. We have acquisition. That's my real estate job. And then we have property management on the other side. So if you are interested in short-term rentals, I'm here to help.
Love it. I'm Gage, and I run the Envision Group. We have, we're just a vertically integrated investor service company. We have building material supply store design center. We have a couple Class A contracting license firms doing different things, everything from renovations to new construction. We take the property all the way to furnishings, if you like. We also have land development, so literally from acquisition of land to furnishings ready to hand it over to your property manager if you're in short-term rentals. We partner with other investors, some of you know, to help them secure funding, to help with the renovations for their fix and flips, their buy and holds, and we do buy and holds and fix and flips internally as well. So we're always looking for deals, no matter what they look like.
Cool. And I'm Mike Capello. Mostly wholesaling at this point in time. Do a little bit of everything, fix and flip, buy and hold. I've kind of touched most parts of real estate investing, but primarily focused on finding really good off-market opportunities, pairing them with buyers. I don't know if besides Gage that buys 70% of my deals if I've sold a deal to anybody else in this room at this point, but I've got deals anywhere really in Northern Virginia. We've been uncovering some in Maryland as well, sometimes in West Virginia. So if you guys are looking for opportunities, let me know, get my card, get on my buyer's list. We're building a team. I'm looking for people that are interested in wholesale acquisition, finding off-market deals. If you know anybody, potentially agents or young go-getters that want to learn about real estate, wholesaling specifically, send them my way. Okay. I'd love to maybe get, whose first GRID event is this? Raise your hand. I know we've got a couple. Come on. All right. if our new folks want to just give us a quick hello, my name is, I'm interested in X, I'm doing Y, quick elevator pitch. You can use this as a little bit of a backstop if you need it, but just quick introductions. It's really important for us to know who's in this room. And for those of you that have been here, please introduce yourself to these folks after. We'll have some networking time. Make sure you connect with them and help them out as well. Go ahead.
Hi, my name is Bob Waddell. This is my first time here. I'm a realtor, licensed in Maryland, Virginia, and West Virginia. I work with some investors. I've got a rented condo for sale now in Brambleton. I've been getting emails, just wanted to come check it out. And
Love it.
Thanks for the invite.
Yeah, appreciate it. Next,
Anybody
up front here.
Hi everyone, I'm a real estate investor and agent. I'm currently working with Gage. We just acquired a 75-acre property in Marin and developing that, hopefully into a micro resort. A couple other things, I've been investing in long-term rentals and just started short-term rentals for Darren. So, yeah.
Love it.
I'm with you.
Oh, okay.
And maybe Ken wants to say hello. Thank you, Ken.
First time here, Ken Pullen. I started investing in single families back in the 80s and 90s and kept those for a few years and ended up selling them in the late 90s and got busy running the business and worked for the government. So primarily went in the stock market and have been happy staying in the stock market, but thinking about possibly diversifying a little bit. So I thought I'd come out and get a little more education on what's available.
Love it. Amazing. Does anybody else have an opportunity or anything they'd like to share with the group? Uh-oh. Yep.
Yes, hi. I'm Karen. I am on day 2 onboarding with Mr. Gage Wilson and Chris here with Envision. I will be building great relationships for the interiors division of Envision Holdings and encourage anyone who is, in any part of this fantastic and fun business, to reach out if it's materials, if it is remodeling, if it is kitchens especially. I can't wait to get going, and I'll be at probably all of these meetings.
Love it. Okay. Anybody have an opportunity they'd like to share, a need or anything? Anybody want to volunteer, or is there anybody that wants to do, I need money, I need a deal, I'm looking for X, Y, or Z before we get started? Maybe we all need money, but okay. Well, we'll keep it short and sweet then. Thank you to you new folks for being here and for introducing yourselves. Again, everybody who's been coming, make sure you connect with those folks and bring them into the fold. Okay, important legal stuff. Don't sue us. We're not giving legal advice. Get your own legal advice. Talk to your CPA. We're taking photos. Obviously, we've got an amazing, Joel, if you want to introduce yourself and give your elevator pitch as well, real quick. The one guy.
Media as well as short-term rentals. We also do commercial film work and photography as well, here in the Valley all the way to DC. So we work with a lot of these guys, helping them out, and yeah, be happy to meet you afterwards.
Awesome. Thank you, dude. And he's taking pictures, so if you don't want your picture taken, too bad. All right, so today, topic, show me the money. Okay, we're going to be talking about private lending, DSCR lending, maybe a little bit about wrap lending, if we can get there. But please feel free. This is like open forum here. We've got some guiding points for our guests, but ask your questions. That's why these guys are here. And we'll go ahead and let Brian go ahead if you want to introduce yourself, and then Patrick, you can give your quick introduction, and we'll get started.
Hey everyone, my name is Brian Castell. I own a company called Restoration Capital, which is honestly probably one of the longest tenured hard money lending companies in Northern Virginia at this point. We started in 2008. Great time to start lending. Remember 2008. Other than that, I guess I would, I don't know, call myself a serial entrepreneur. I own several companies. I love real estate, I love finance, and I love cash flow.
Amazing. Go ahead, Patrick.
Well, first, thanks guys for inviting us, and nice to meet you all. Patrick Browning, I own a company called Neighborhood Lending. Rather short history, unlike my partners here. We started about 3 or 4 years ago. Come from a family of bankers, and we saw that there was a need in the especially community banking was a big lender to commercial real estate in the last 10, 15 years, but that's been pulling back a lot. So there's been an opportunity for private credit or private lenders like what I do to service investors like you guys. So started, like I said, just 3 or 4 years ago, and have seen lots of successes, lots of really cool stories, seen people see their dreams kind of come true. So happy to share what I've learned so far and how we structure some of our deals, and happy to answer any questions as this night progresses.
Awesome. Thank you, guys. Okay. Without further ado, so one of the things that we want to talk about is, I think one of the biggest misconceptions in real estate is I don't have any money to buy deals, right? And that's why we brought these guys in, because money should be, if you've got a good opportunity, money should be the least of your worries. You've got a good deal. There's plenty of people out there, private lenders, hard money lenders, DSCR lenders that are going to lend on any good opportunity that they see. So when you guys are sitting and thinking about where your gaps are and where you are now and where you might want to be in your investing, journey, today we're going to talk about money, but these guys are here for when your conventional lenders are not going to be available to you, right? For our fix and flips, or our, non-conventional type deals where we're not buying a primary residence or using some kind of conventional lending. So why don't we talk a little bit, I don't want to sit here and read off these slides. Why don't we talk a little bit about, Brian, if you want to go ahead and get started. Private money lending, what does that mean? How do you service your clients? What types of things are you looking for when you're lending on deals?
Curious if I thought, man, who is hurting from part money lending? Do you guys know what that actually means? I mean, it's not, okay, I like that. If you're not paying, it's not, Tony Soprano's not coming after you to break a leg. A lot of people come to us with, well, you just lend to people with crap credit. It couldn't be further from the truth. Hard money lending in general is just lending against a hard asset, so namely real estate. It's equity-based lending. So we don't really look at your income, your assets, your tax returns. We personally care about your credit, but not really what the score is, to be honest. We care what's on the actual credit report. So if a client comes to us, or a potential client comes to us with, a 20-page credit report and, 19 of those pages are junk trade lines and they don't pay anything back on time, I'm not going to make you a loan. Like, we're not looking for trouble. We're not looking to to basically take over somebody's property when they default. We're looking at making solid loans to solid borrowers who are going to pay us monthly and then pay us off on time and make money in the process of doing it. So it's almost like renting money is the easiest way to describe it. But I wanted to make, I guess, that distinction first versus what, conventional financing might be, where a loan officer and an underwriter are looking at your income, your assets, your tax returns, and scrutinizing every little thing. So to answer your question, what do we look at? I call it the 3 E's, if you will. So the equity in the deal, meaning are you buying it well? Are you going to improve it to the point where it's going to be worth more than what you paid for it? The experience of the borrower. Is this your first time doing it? Do you flip 10 properties a year? We'll lend to anyone. It doesn't make a difference to us, but it actually will help us determine how much hand-holding you might need in the process of actually flipping a property, and help set us up for success when we're dealing with you. And then the third E is the exit from the deal. So in particular, we generally try to look for two viable exits. The first one, if it's a flip, is always a sale. But if for some reason the market stagnates or interest rates skyrocket or inflation's out of control or we have a 2008 again, can you work through it? How can you work through it? Well, maybe you've got strong enough credit that you can go out and refinance. Maybe the cash flow off the property will be good enough that you can go out and get, a DSCR loan that we'll talk about, I'm sure, at some point. But in a nutshell, hard money lending is speed, especially when you're dealing with folks who know what they're doing. So one of the other things we wanted to talk about, I wanted to talk about tonight is there is a major difference between the two of us, because we're actually very similar, versus what a lot of our competitors do. What I mean by that is roughly 2015, 2016, this industry changed dramatically. And how did it change? Wall Street actually became very interested in what we do because they see that the notes that are being generated are producing good, solid interest rates for people. So they're like, well, we can do what Freddie and Fannie do. We can start bundling those together and then buying them and getting higher rates of return. What that ended up doing was putting a lot of folks like us, I'm not going to say out of business, but slowing our business down tremendously initially. And the difference between us, at least from what I know, versus, again, 90+% of our competitors is we don't sell our paper. Meaning we are originating, we're servicing, and taking care of the entire process with a borrower from start to finish and holding on to that paper the whole time. It's our money that we're lending. So our competitors are generally now underwriting to somebody else's guidelines, requiring appraisals to do it, taking anywhere from 15 days to 2 months to close, and we can still close loans in a matter of days. So it's a big difference. We don't require appraisals. We don't have to underwrite to other people's guidelines. And we'll get into that a little bit more, why that's such a big difference.
Yeah, and one thing I just wanted to add, I think Brian encapsulated a lot of the topics I actually wanted to cover, especially the one item you're talking about, where hard money banking kind of has this negative connotation, and it still does. Like when I say that I'm a hard money lender, sometimes people think, oh, you must be a lender of last resort. That really isn't it. We like you were saying, execution and speed. One thing I would like you to come away from tonight, you might already know, but time kills deals. And one way that you can try and mitigate that becoming an issue for you is, although private money or hard money might be a little bit more expensive, at the end of the day, you're paying for that execution speed and the timing.
Potentially saves the deal.
Yeah.
Anybody have any questions about any of that? Can you guys explain the difference between private money, hard money, ESDR? I think that's kind of the three.
Private money in general. When I think of private money, I am generally thinking of a wealthy doctor, an attorney, an accountant, somebody maybe who's retired and sold a business, who is basically saying, hey, I will help you along with whatever it is you're trying to accomplish. That is like genuine private money. I wouldn't say they have an infrastructure in place necessarily to help you if you run into a roadblock. Hard money is, I think, that kind of beefed up a little bit, if you will, maybe more of a bona fide lender, somebody who does it for a profession. They may or may not have, a real sizable business. They might be completely self-financed. They might have a credit facility behind them. And then DSCR is something completely different, which is, to me, I would classify it almost as a cross between private money and hard money and bank money. So it's underwritten literally as a hybrid. You have to supply a little more data maybe than you would to a hard money lender or a private lender. But they are basing that loan off of the debt service coverage ratio of the actual property itself and what it's generating, not necessarily what you are generating revenue-wise. In fact, it has nothing to do with what you're generating. So they're generally 30 years on average. They generally have prepayment penalties, but they are lower in interest than what a private money or a hard money lender would charge, but a little more in interest than what a conventional loan would charge. Big difference between DSCR, private money, and hard money. DSCR, and this, I literally answer this question 10 times a week. DSCR money does not ever give you any renovation funds. Okay? So if somebody is saying it does, it doesn't. There's no such product as that exists, and there's a reason for that. But essentially what people would do if you're going into a property and you are going to renovate it and then decide to keep it as a rental, you're usually going in with either private money or hard money, renovating it, and then exiting with a DSCR loan long term, or if you can qualify for a conventional loan, that's perhaps even better. DSCR, another, I guess, distinguishing factor, they like to lend to LLCs or companies or corporations versus individuals, versus maybe a conventional loan, which you didn't even ask about that, but I'm bringing it up. Conventional, they really don't. They like to lend to people individually. So, what about use case? Use case for,
I don't know if maybe you want to touch on that. Use case for private money, you sort of alluded to it, but specific use case for private money, hard money versus DSCR and maybe a conventional.
Well, I think use case for hard money and private money to me are interchangeable in a lot of ways. But really, it's for hard money or private money, it's if you've got an asset that might be distressed, like a fix and flip, that's the type of use case for private or hard money. If you've got a seasoned asset, meaning you've got something that's cash flowing and showing cash flow for a period of time, that's when the DSCR loan will come into play.
Yeah, there's a lot of cycles in real estate. Everyone here knows that. But it's amazing that over the last 20 years, I think I've seen pretty much all the cycles now. And it's funny because literally, 10, 12 years ago, 90% of the deals we were doing were foreclosures, right? Investors going up to the courthouse steps, buying properties, and in Virginia, you got 15 days to close on them. So, use case, hard money, private money, period. There is no other solution. Or cash. If you've got cash, it's a great solution. But I can tell you, like some of our top clients, was one woman in Fairfax County. She owned 50 free and clear single-family homes in Fairfax, and she still used restoration capital for all of her loans. Why? To me, that made very little sense. She was worth in excess of $100 million, and she's still using it because she understands the value of leveraging somebody else's money, keeping her cash available for whatever it might need. But those loans, right, those foreclosures, which they're starting now to pick back up again, that's going to be our next cycle more than likely, they've got to close in 15 days in Virginia. Or you lose your earnest money deposit that you put up at the auction. Trustee will say, thank you, and keep it, and move on to the next highest bidder. So you have to have a dependable private money or hard money source, period. DSCR can't even close it that quickly. So.
Right, and just to add on to that, just being able to close quickly is such a competitive advantage. But it's so hard to find deals, as many of you probably know. But if you can go in with a strong purchase offer and the ability to say, hey, we can close in X business days, subject to clean title, already got my lender lined up, that just puts you so much further ahead of the game and may help you win a deal. So going back to the time, execution, it all helps you ultimately get the deal and move on to the next thing. So.
Yeah. When should I come and talk to you? How do you know do I need $100,000 to buy a place, $200,000, $500,000?
Or do you tell me, okay, you qualify for $500,000, you qualify for 200,000, or how do I know when to come to you? And if I look at a place, yeah, it might be too late. By the time I come call you and you say, well, you gotta do this, this, and this, even though they're gonna take 10 days, that's 10 days that somebody else is already ahead of me.
Good question.
It's a fantastic question, and it really depends on what it is you're trying to do. So if you're going out, you want to flip a property. At least in my scenario, I would probably have you talk with our loan origination manager who would get to know you. One of the questions we ask, and I kind of want to back up for a second. We are a little atypical in that I consider us a fairly large boutique hard money lender. What I mean by that is we actually care about you more than like these big institutional hard money lenders across the country that lend in every state. So one of the answers to that question is getting to know you a little bit before you're going out and doing whatever it is you're getting ready to do. One of the questions we ask you is, how much working capital do you have available towards this transaction that you are comfortable spending? It's a very, very pointed question, and we're trying to get a very, very pointed answer from you because that tells us a lot, right? If you tell me I only have $50,000, I'm going to say you more than likely need 20% to put down, you more than likely need closing costs, and you definitely need enough money to start the project. What do I mean by start the project? Well, I don't know, let's say you have a $50,000 budget. I personally don't care if you want to take that $50,000 in 2 draws, or you want to take it in 10 draws of $5,000. It makes no difference to me, because I'm not the one going out and doing the site inspection. You are going to pay for somebody to do those. That makes a difference to you. Every time that somebody's going to come out, it's going to cost you $150 or $200 to get that $5,000 or $10,000 or $50,000, however we're breaking it up. But the reason we ask that question is we want to know what we're working with, because ultimately, we want to set that client up for success. We want you to succeed. We want you to make money. We want you to come back to us over and over again and tell all your friends about us. So if the deal goes sideways or goes bad, it leaves a bad taste in your mouth, you're going to tell everyone that Restoration Capital stinks, and that's a problem. So we don't want that to be the case. We will tell you straight up if we think you have enough for what it is you're trying to accomplish, or if you don't. We'll tell you if we think you might need to get a partner, or you might need to find a line of credit, or any other solution that we can come up with. A lot of things, we can overcome a lot of issues. Okay? One of them that a bank, for instance, cannot overcome is a lack of equity. What do I mean by that? Somebody had said earlier that they've got a property in Brambleton that they've got on the market right now to sell. I would ask, what's the debt on that property and what's that property worth? And then we could say, hey, you don't have the 20% plus the start of the draw, well, we can use that property as cross collateral and give you higher leverage to make up for it. Banks generally will say, bye-bye. They're not going to deal with that because it's outside of the box. It's creative. It's a solution to a problem that they don't want to deal with. That's why we're in business, because we deal with them.
Can I just speak like this? Oh, perfect. So quick question. So typically, if you're doing fix and flips, right, it's going to take 6 to 9 months to kind of hopefully fix it, and then maybe sometime after that to flip it. You mentioned the DSCRs don't have early payment penalties.
No, they do.
Oh, they do have early payment penalties. Sorry, misspoke. You guys, if we decided after the seasoning period we wanted to use you guys, and a year we wanted to refinance to a conventional or some other type of loan, are there prepayment penalties? How do you guys typically work in that situation?
So every lender is different. I can tell you how we operate, and I can certainly answer you. In 20 years of lending, I've never charged a prepayment penalty. I personally don't believe in them. I think it's just a money suck from clients who are trying to make money. And I don't know why I would ever penalize somebody for actually paying me back. I think it's counterintuitive. So that's my answer. We also clarify a couple things. Hard money lenders, private money lenders, none of us are lending our own money for DSCR. If we are, you're a gazillionaire, because I don't know who can put that kind of money out, at 6 or 7%. It's insane. So the reason I bring that up is, if Restoration Capital is originating a loan that we are not going to service, the only one would ever be is a DSCR loan, and those all come with whoever is actually purchasing them, it's guidelines, right? That's why I said 90% of those loans or more, to be honest, have what's called like a sliding prepay penalty. So usually if you pay it off the first year, it's 3 points, the second year, 2 points, 3 years, 1, and then after that, there's no prepayment. But
And generally, we don't charge any prepayment penalty. Sometimes, depending on the project size and scope, there might be a minimum interest that's due, but no prepayment penalty.
I think to double click on that scenario, you said thinking outside the box, because I think that's the biggest hang up for a lot of inexperienced or newer flippers, whatever. Can you double click on the outside of the box thinking of, yes, 70% or 80% of LTV that come with that 20%? What are some creative ways to be able to come to the table with, those creative ways?
I mean, for us, we want to get a good picture of who that client is, what they're working with, and then obviously, jump off from there and figure out what the solution might be. But I can tell you, because we are lending our own capital and because we don't have to deal with, the institutional players in this country that want a certain level of experience, or a guy who's flipped, 3 properties in the past however many, years. We get a lot of folks who have no experience or they're just getting started. What we will generally try to do is pair them with somebody that we've been lending to for years and see if they can help them out, or if we can put 2 or 3 parties together, so you can form an LLC and flip a larger one together for the first time. Or, look to see if there's other type of collateral that we can use. Like, definitely use some weird collateral over the years, but I mean, generally speaking, we really are real estate, right? It's pretty rare. With this building, this beautiful building we're sitting in, Restoration Capital actually financed it. And I can tell you, with all the stuff that the woman who has going on, who owns all this, we had to get very creative, right? Because there's a lot of moving parts going on. But it's just working toward a solution that makes sense for everyone.
And to add on to that, creativity doesn't always mean more risky. It's how to take that risk and realign it to find the solution. So, Brian mentioned earlier, one of our classic creative solutions is if you own lots of other property with equity, okay, you might not have the full 20% down plus closing costs to fund this loan, but hey, if you've got an apartment building or a townhouse that you're renting out, you could lever that up to get into this one. So
there's one of the things I'd add too is there's a level of trust that gets developed, if you will. So I can tell you, like, I have countless clients who literally will text and say, hey, I'm putting an offer on this property for this amount of money, and 10 minutes later we have a pre-approval letter in their inbox, or whomever it is, a wholesaler that might need it. Or, I just purchased this other property. I'm a little tight on cash right now. There's always a workaround, especially if you've kind of been working with the same lender for years, and we know you and we trust you. There's always going to be times where, money's a little bit tighter. It goes without saying, or somebody goes through some sort of, major medical event or a family event. And that's why I alluded to what I said earlier, like, we don't really care what your credit score is. Like, I just did a loan, I'm not even kidding, I closed a loan today to a woman in South Carolina. Her credit's in the low 500s, but she went through a nasty divorce and her husband destroyed her. So if you looked at her credit report prior to that, she was an 800 plus credit score. She had every trade line was perfect, but then if you look from the time about 6 months before the divorce until about, 6 months ago, turned to crap. So, to me, that's okay. That's not even an issue. We'll figure it out. We can make that one go away.
So I have two questions. The first one is more specifically on, you mentioned that you could use rental properties
As collateral?
as collateral. How do you normally use them as collateral? Let's say that I don't have the 20% to put down, and I have a couple of rental properties that are paid off completely. How would you use those properties as a collateral? And the second question is, normally I fund my deals with my own cash, and I'm limited to like 2 to 3 properties per year because of the cash, right? Let's say that I want to leverage those properties and get more funds to do more deals. What's the process like? And what's the, like, what points are going to be paying? What percentage to, let's say that I need, I don't know, throw numbers out there, 400,000, right? Like, what's the process going to look like to get those funds, the cash? How many points are going to be paid? What's the timeline that I have to pay those the money back? And if I go over the limits, because usually I take about 4 to 6 months to do my fix and flips. And let's say it takes over 6 months. What's the penalty look like?
Okay. Hey, you want me to go for that one?
Sorry, now I'm thinking back.
A lot of questions. Okay, so as far as using a rental property as cross collateral, we do it all day long, every day of the week. And we love those loans. And, I mean, from what you just said, you're probably like our top tier client. We love clients who have free and clear assets that are willing to use them and not even touch the subject property maybe that they're getting ready to acquire. So that can be done in several different ways. The first is just like a cash out bridge loan, if you will. So we use one of the rental properties. You can take cash out of that property, use it for whatever you want to use it for. I mean, business purpose, obviously. The other is a lot of times, and by doing that, back up for a second, the lien on the property would be for whatever the actual loan amount is, right? But if you're using it as cross collateral, meaning you're lending on a subject property that you're maybe buying, and you don't have quite enough money, like you said, and you want to use a rental property, well, then we're putting a loan against, we're securing the loan against both properties, right? I don't know how technical you want me to get, because we can get into different states. There's different laws, but Maryland, Virginia. Okay, Virginia, it's actually pretty easy. So usually it's a deed of trust and a supplemental deed of trust. Okay, that supplemental deed of trust lien amount can be for whatever we need it to be to get you wherever you need to be. Meaning it doesn't need to necessarily tie the loan amount. It can be less than the loan amount. So in other words, you needed $400,000. We were only comfortable lending $300,000 against the property you were buying, and we needed $100 from a rental property. Well, we could just put a lien for $100 on the rental property instead of 2 liens for $400 or $300, whatever. There's a lot of ways to skin the cat. The other question was term and penalties. Again, we would structure the deal in a way where hopefully you wouldn't have to deal with any of that. So if you said, hey Brian, I need this money for 6 months, I'm going to come back with, are you positive you only need it for 6 months? Like you have everything lined up? Because if not, let's do a 9-month loan or let's do a 12-month loan. And the reason why is it's really not that much more expensive. It's like a quarter point or half a point more to lock up the loan, the money for that much longer. But why not just be certain that you've got it? Because with us, if you go beyond, if it goes through maturity and you need to extend it, it starts getting more expensive. So it's usually with us, it's a 1-point extension fee, and the rate generally goes up 2 or 3%. So, and that's only usually for 3 months. So you go another 3 months, you're paying another point to extend it. At that point, it almost becomes cheaper to just refinance the whole thing and keep it for another, same term. So our idea is we don't want people really going into extension unless something is usually going wrong if they're going into extension. We want you to be set up for success from day one, not be over leveraged, not ever be in a position where you might run out of money. Does that answer those questions, or is there something else?
Are personal guarantees common in these types of loan? And then the second one is, if I have a DSCR loan, how would a conventional like lender look at a DSCR loan? Will it come on, will it show up in my credit like a conventional loan or an FHA loan?
So tackle.
I'll tackle the first piece, unless we don't originate DSCR loans, so I'm not familiar with that. But so I won't speak for Brian, but every hard money deal I do, I require a personal guarantee. And it just comes from the philosophy that neighborhood lending has. We want the borrower to stand behind it, have some skin in the game, not just their cash equity, but also have, some skin in the game. The main reason being is if things go south, it's a lot harder, honestly, for someone who's got a personal guarantee to walk away. I want that person to be hand in hand with us. So other lenders might do it a little differently, but that's what we do.
Yeah, to answer your question, I don't know any lender that doesn't require a PG. Generally speaking, almost all notes, the notes that are actually getting signed, the promissory note or deed of trust note, has what's called a confessed judgment built into the note. What does that mean? That means if you default and you're bad, not because you've defaulted, but because you're playing games or whatever the fact may be, the lender could essentially go straight to the clerk of the court and record a judgment against you without going to trial. You still have 21 days to respond and argue it. I can tell you in 20 years of lending, I think I've used it twice, and they were both due to fraud. So it just it is very commonplace, though, to answer your question. That I don't really know anyone that doesn't require it. Your second question with DSCR. How does it flow through a credit report? What was your question?
Does it show up on a credit report like a conventional loan?
Yeah, no, generally it does not. So that's another major positive, right? You're taking the loan in the name of an LLC, usually not reported. I can't speak for every DSCR lender across the nation, but the majority of them do not. If you default, they usually will report it.
Just a follow-up to some of your answers. So two different ones. So the first one is, say you have a property that's free and clear. What type of LTV you typically, basically, what percentage of equity do you still want in the property? Is it 25%? That's typical. Do you 10, 0, something like that? The second question, I forgot the second one. What comes to first?
It's good, 'cause my memory's not good enough to answer multiple questions.
I guess what was the scenario?
Say we own a property that 100% paid off, and we wanted to take, and we could do a typical cash out refi, right, for conventional. They require typically a 20 to 25% equity still in the house. We only can take 75%.
Well, I guess my question is, what are you trying to solve for? Are you trying to buy a property? Because typically I don't just do like a cash out refi.
Oh yeah, the cash out refi would be to invest in other things, like other properties.
I guess my question would be, what's the source of funds, or what are you going to use those funds for? Like,
business purposes to basically build a new build or do a fix and flip and just have more cash on hand for that, as an example.
Yeah. So I know where you're going already, so I just thought the same thing. So ultimately the question is, how do you plan on paying the loan back?
Oh, basically buy a property, rent it, short-term rental it, essentially have income off of it. We wouldn't be...
But that wouldn't pay the loan off, that would just cash flow the debt, right? You have to sell something or refinance the entire note to pay off the actual debt. So the reason we're both asking the question that we're maybe not asking very well is it depends on what you're trying to accomplish. So if you're literally just trying to pull cash out of something short term to use toward building it, whatever it might be, the question is, how are you going to pay off the loan that you've borrowed? Are you going to refinance the property that you're building and pull cash out of it to then pay debt off on another property? Or are you going to sell the property that you've just built? Because that then depends on what
because
our answer.
Like 15 or 30-year loans are typically shorter loans.
Exactly.
That makes sense.
Yeah.
Okay.
So
that's what I was missing.
So what you usually will then determine how much LTV I might be able to lend against that property.
So your term loans are basically about a year.
Yeah, I mean, we do one-day loans all the way to 2-year fairly regularly. On average, most of them are 12 months.
Which is why fix and flips are the ideal, loan type.
Yeah.
That makes complete sense.
Yeah, and/or bridge. But if, for what you're trying to do, I mean,
I'm just more curious, and
yeah, for your other question, like LTV wise, and it's actually a really, really good question kind of for everyone to hear. There is no set LTV, like with a pure private money, hard money lender, period. Somebody tells you there is, there really isn't. It's how comfortable that lender is lending in whatever area that property is in. So if you come at me with something in inner city Baltimore or southeast DC, my LTV is going to be a lot different than if you come to something in Bethesda or McLean or Falls Church or Arlington or Northwest. I don't want to have to deal with the mess that will likely happen with somebody that doesn't know what they're doing in those cities. The other thing, a lot of people, and this is getting really high level, but jurisdiction state by state matters to us. Why? Well, if a deal goes south in Virginia, it takes me roughly 45 to 60 days to foreclose if I have to foreclose. And I don't say that, like we foreclose all the time. You can count, thankfully, the foreclosures we've had in 20 years still on just one hand. We really strive to put together deals that make sense. But as Aaron has helped me out of a deal before, sometimes things go sideways or, there's fraud, and it just happens. But that, where that asset is, and the time it would take me as a lender to foreclose on that asset and try to recoup my money makes a very, very big difference. Why? Again, 45, 60 days in Virginia. Deal goes bad in Maryland, I'm looking at a minimum of 6 months, more like 9. Legal fees, roughly $5,000 in Virginia. Maryland, $20,000 to $25,000. Baltimore might take a year. DC, I might never be able to foreclose. So, I mean, it's just, and then you got a squatter, good luck getting them out. I'm dealing with 50 right now as we speak. So, it just depends on all those things. So where the property is located, what the property looks like in its current condition, those things don't really matter as to whether or not we'll lend on the asset, but if there's structural issues, I'm probably going to take the LTV down a little bit to make up for it, right? Mold, maybe not.
Hi, it's common practice for hard money lenders across the board, particularly like you were talking about the bigger ones across state lines, et cetera, to monitor projects, work on a draw schedule, review the SOC, scope of work, and maybe even utilize, tools like SiteWire to verify inspections, et cetera. Do you do anything like that?
We do, yeah. So we generally work off draws. We have 2 products kind of designed towards fix and flips. One is just a very traditional kind of hard money loan with construction draws built in that's in reimbursement style. So client starts with whatever the first phase might be, demo or plans, whatever. Once they're done, we reimburse. And then same thing over and over again throughout the process. We generally use real people. We generally will schedule the draw schedule the very next day after we receive a call, email, text. Have them there the next day. We'll get a report and pictures that night, and we'll literally ACH the money the very next day. So our process is roughly 48 hours. It costs on average $175 per draw. We are lending, in other areas of the country, not as much, but for those where I don't have kind of boots on the ground, we will use, those type of companies, SiteWire and various other ones that have technology involved, where pictures and cameras and live stream and all that. Yeah.
Yeah,
I'm not.
Well,
I'm not a big fan of Sidewire.
I don't have a problem. I think Flatwire is an amazing asset to, this industry. But in this situation, the hard money lender said, Sightwire, what are they going to do for us? Oh, well, they have this great software. They're going to GPS. They know where you're at. You have to stand in the same places and take those pictures time and time again. I mean, they're really validating. They're supposed to have a contractor. So, they hire independent contractors who then verify your project from draw to draw to draw.
Yeah.
Well, this hard money lender decided, I've done fix and flips and renovations for 7 or 8 years, and I think I can handle it. So he says, Sightwire, I want your software, but I don't want that process of making sure, that the borrowers are actually doing the work. He didn't say it like that, of course, but that's what happened. We had a project with Sightwire. We were told by the hard money lender company, because we said, absolutely, we needed to have that insurance of knowing that there'd be a contractor who's overseeing this project. That the ground guy can go back and forth with it as well. And that never happened.
Yeah,
at
it's
all.
actually.
And I didn't know that they were allowed to do that. We wouldn't have thought to ask that kind of question, that if the hard money lender says to us they're using Sightwire, or any other product, by the way, you guys should make sure you find out how they're using that product.
Yeah, it brings up a really actually valid point. Not all lenders are created equal. I don't know how else to say that, politely, but when you find a lender who actually understands a draw process and is not a bank, latch on. Yeah, that's all I'll say, because I cannot tell you how many deals we get from Fallout when somebody's really closed on a property, they're trying to get their very first draw and they can't get it. And they're just like, they're fed up with the lender and like, just refinance it out and start over. And they come to us. And we're not looking at invoices, we're not looking at checks, paid receipts. Literally, you give us a line item budget before you close of what things are going to cost and the order in which you want to do it, or you don't even have to include that, because as it gets done, we reimburse you. That's it. We send somebody to go look at the actual property. Yes, the floors are there. Yes, you got money coming back at you. Yes, the appliances are there, but they're not installed. Okay, we're going to give you 50% back until they're installed. I mean, that's it. It's not, hey, let's just every single penny, let's make sure it's right. And that's super important when you're in this business, because speed is everything, right? If it ties up, you can't get your construction money back out, you're just not doing well.
I have a thought, and then I want to shift gears really quick. 7:15, we've got another 10 or 15 minutes here. If you guys haven't gleaned this from this conversation yet, these guys, or whatever lender you decide to use, are going to be your best friend and your best defense, especially if you're fixing and flipping, that you can find. They're out here. Not only are they your lender, but they're your underwriter. They're looking at your deals. They're making sure that you're getting yourself into a secure deal, especially if you're just getting started. Maybe you have a little bit of a more difficult time getting a loan approved. Maybe you partner with somebody, but these guys are out here looking out for people like us that are taking money from them. So, get these guys in your corner. I have a couple slides here about, your team that you want to put together. If you're doing any kind of fixing and flipping or buying and holding, and that's really kind of the next direction that I wanted to go in, make sure you've got a good hard money lender, private money lender, somebody on your side that's looking over your shoulder, making sure you're getting yourself into a good situation. You can have your agent, you can have, a partner or whatever, your contractor look at things, but these guys are looking at hundreds of deals, thousands of deals, I don't know, 20 years of experience. That's the guy you want looking at your deal right before you buy it. I wanted to shift gears, though, and talk a little bit about the market and what you guys are seeing in your space. And we've kind of talked a little bit about a renovation loan. There's kind of this strategy that we hear a lot about, which is in my opinion, mostly, especially in our market, not really existent. But when you guys are lending on these hard money loans, are you seeing people being able to refinance and pay you guys out and you know, basically become whole with that property at the end of that? Or like, what's the general sense of the market right now from you guys and what you're seeing with hard money and then converting into long-term debt?
I mean, I can answer both. I feel like
I don't know if that question makes sense.
So, from a general market perspective, things have been very competitive over the last 4 or 5 years in general, specifically in the fix and flip realm. I mean, I feel like deals are just very hard to come by, both from an investor perspective, and there's lots of private money, hard money, all types of money out there, it seems like. Everyone seems to have cash, at least when some of my borrowers are competing for deals. So very competitive. That's why kind of my theme of the night is time kills deals, and being efficient and being able to be competitive and win the deal is very important. I guess your second piece was about the refinancing, and so I've had several borrowers that have successfully refinanced out, but that was part of the exit strategy. Kind of like when one of the things I ask my borrower when they come to me and say, okay, what's your plan for the property? Oh, I'm gonna, for example, I've got a lady doctor who got a equine facility in West Virginia. Really cool property, but it was unbankable because it was distressed and it was an equine facility, meaning it was a barn that housed horses and also an apartment building. No community bank was going to touch it. Lots of the institutional hard money wasn't interested in touching it because it didn't check a box. But she told me at the very beginning, Patrick, you're going to provide me the bridge financing to get me in. I'm going to renovate it, and then we're going to refinance that out. And what we've done is we've structured it so that she can successfully, hopefully, find a community bank or a larger conventional loan to refinance her out. Okay. I've seen one other client who's refinanced out of, they came to us, we gave them the acquisition and construction funds, they successfully completed the job, they got the refinancing, cashed us out, and was able, now they're doing a short-term rental actually in Washington, D.C. So I've seen success. Do you live in it?
Yeah.
No.
Yeah, DC's requirements are now that they live in the property or in the 80 somewhere. Unless they have a bigger hotel zoning. So that was kind of where I was going to ask the question. So in my experience, I've seen people using DSCRs. We had one, Northwestern property. Going to take a $300,000 renovation. He was involved in a lender in California, something like that. They just didn't know what they were doing, in my opinion. Long story short, we got her out of the deal. She got her earnest money back, but they weren't able to give her the loan for certain guidelines. It was rural, was the number one thing. And over 5 acres was the second. They could overcome certain impacts to that, but what do you see with rural? Because I'm doing a lot of out this way, Bryce Resort, and other things. These properties need renovation. We're not going to bring all our cash. Yeah. So you're going to bring your money, basically. Do you have any rural designation?
No, for us, it's just we usually have a 5% property loan.
Got it.
So instead of 70, we might only lend to 65.
Yeah.
That's where we are. To answer your question, from my perspective, we're not seeing many issues, I guess, at this point. I will say in 2025, we did more loan modifications than we've ever had to do for our loans. And that's just, I guess, to some extent, the way I run the company, in that I, again, always want to see the borrower succeed to the point of sometimes being detrimental to myself. So I I will do whatever I can to help the borrower. If it's they need a little more time, they ran out of money, a contractor ran with a draw, whatever it might be, we will usually modify the loan before it becomes a bigger issue.
Is that like properties not selling?
It's all of the above. Yeah, everything. I mean, every month it's something. So there's a lot of fraud. There's a lot of contractors who just want to take your money, and it goes back to developing that the team of trustworthy folks that you're working with.
Having just dipped my toes into the hard money world here, I think some things that might help some of the newer people. Can you go over what some of your typical terms are for a hard money loan? We covered the length of the loan, typically less than 2 years, but points, interest rates, Dutch interest, that was a term I had not heard before. 20 years of real estate, I had not heard that. So
that's
just kind of like the basic.
I love talking about Dutch interest. So it's like the bane of my existence. So remember I was talking about like 2015, 2016, the market changed. Well, one of the things that got introduced into the market was Dutch interest. What is Dutch interest? Nobody's really ever heard the term. So we will lose a deal maybe once a month to another lender who will remain nameless. No, they won't. Yagi. We'll say it. Why? Well, because their interest rates are like 2-3% lower than mine. Well, how is it that their monthly payment is more than mine? Dutch interest. Dutch interest is when the lender is charging you from day one based off the entire loan amount. So say we have a $250,000 loan, $200,000 got released at acquisition, at settlement, $50,000 is left here, $100,000, whatever you want to call it. Whatever your renovation budget is, that's the delta, the construction reserve. A Dutch interest lender is charging you on the full loan amount from day one. Maybe a slightly lower interest rate than what Restoration Capital is charging you, but when you do the math, you're paying more per month. So simple interest is the way hard money was intended to be, which is, I'm hoping that's what you charge.
I usually actually charge Dutch interest.
There you go. All right, so here's what I will say. If a lender is charging Dutch interest, there better be a deal. There better be a good reason. Now, it's usually, in my humble opinion, it should be when the construction reserve is so small, like it's a cosmetic fix and flip, right? That literally 1 month in, you're going to be fully drawn out. If you have a very, very large construction reserve, like you're doing a pop top or a major renovation, or expanding, the footprint of the property, whatever it might be, and you're getting charged Dutch interest, I personally wouldn't take it.
To kind of piggyback off that, your pricing and terms, it all depends on what the deal is, how big it is, how small it is, how complex it is. So it's very hard for me to go up here and tell you, okay, yeah, we do 12, 13%, 2 points, 3 points. I just don't know what your deal is. If it's super small in Baltimore City, I might be at 15% and 4 points. And Dutch interest because it's a small loan. If it's an $800 million new build, yeah, maybe I'm not charging Dutch interest on the full portion or not at all. Maybe I'm charging you a lot less interest if you've got a major net worth. So the key is getting to know one of us early on so we can get to know your character, get to know what type of deals you do, how experienced you are. You don't have to have any experience to start, but once you start to build that relationship, then you can start to reap those rewards by getting maybe better pricing, terms. Like I said, even you might be an extremely good borrower, but if the deal is really hairy, then the banker needs to be compensated for the risk. And so that's what it's hard to say, okay, here's what the interest rate would be or the points.
Yeah, it's volume driven, it's supply and demand driven, and it's location driven.
Location.
It's all of it. So, to answer your question as best I can, my hard money ranges from 1.9% to 5 points and 15%. On average, 12 and 2. 12 and 3.
Higher than what you get. higher than what you would be getting with a conventional loan,
100%.
shorter term. You know, it definitely, fills the need, but there are different costs associated with it. I just thought we should cover that.
Yeah.
I have a quick question. You guys had fees for this first appointment. How does this first introduction work on your company?
Yeah, no, there's no fees with us.
Just call in, make an
yeah.
appointment, and go have a chat.
Yeah, I mean, it's a conversation, it's a coffee, it's a lunch, it can be anything above.
Phone call, email. It's not just us, it's like earlier in one of the slides is building your team. You might have a trusted real estate agent. They might have some contacts. It's just nurturing the relationship as soon as possible. That way, when you do have that deal in front of you, you're not scrambling, trying to put everything together. That's when things don't work out exactly the right way.
Yeah, these are partnerships, so you go to lunch, grab a coffee, you sit down, you build a relationship, you do a couple deals, you maybe become buddies. Now I got 8% loan at 2 points. You know, it is, these are how.
And in fact, there was some truth to that. I honestly, like, I had 2 deals in Pennsylvania go bad last year. I don't have an infrastructure where these went bad, but one of my borrowers, I've been a borrower for 15 years, I literally just said, hey, take care of this for me. Go up and do the construction at cost. I'll pay pay your labor, I'll pay your materials, and then the very next loan you need, I'll pay for it. 0 points. And, you got to pay my interest at least, so I got to pay my investors. But, we make our money generally off the points. That's where that's our bread and butter. So, we can scrape things there as long as I have a deal in place with, my capital sources, which I do. So, it is very, very relationship driven. It is very supply and demand. Right now, there's quite a bit of money out there, but there's not a lot of good lenders out there. So it's a lot of institutional hard money. There's very few of us left. I can't stress that enough. Very, very few of us left. Yeah, institutional hard money, I kind of alluded to it earlier. It's when Wall Street got involved, everything got messed up. Lenders like us, I never sold out. I never signed up with any of them because we have our own capital sources, right? But the folks that maybe they only have a few $1 million that they're playing with, you can't do a lot in Northern Virginia with a few $1 million lending. So they said, hey, we'll sign up with these folks. We will originate the paper to your underwriting guidelines, and then we'll, get sold the very next day to a private equity fund, to a hedge fund, whatever it might be. So that lender who you've been dealing with is no longer collecting your mortgage payments, right? It's now somebody out in California or New York or Texas. And it's a pain in the butt, and you need a payoff statement, and it takes a week to get a payoff statement, and they charge you $250. I mean, it's a joke. So that there's so much to be said about the simplicity of hard money and what it's supposed to do and how it's supposed to work, and the speed thing is huge. We have clients who call us and say, hey, I want to put an offer on this, but I'm going to come in $75,000 less than what they're asking. I'm like, okay, do you think you have a chance of getting it? And they say, well, I'm going to tell them I can close in 3 days. Can you close in 3 days? Okay, we'll close in 3 days. I mean, that's basically what happens. Yeah, if the title work is done, sure, we'll get it done for you if it helps you win the deal. And there's super value in that versus, a bank's not going to be done taking your application and ordering an appraisal in a week. So
to piggyback on that, institutional hard money is just almost like a bank. Very, here's our checklist, here's our box of parameters. If it doesn't fit within our parameters, sorry, move on. Where we, I would think, would take a look at, tell me what you're solving for, let's see how we can get this done. I don't have a metric. I have loan guidelines, but we can figure something out where institutional, it's a lot more rigid.
Yeah, I had an opportunity. This was before I was really into the game, but it was high-level CEO. He just got this company. He was making $25 million a year. He had all the cash in the world, except he didn't have any seasons. He only owned it for he wanted to buy a 200-acre mountain in Washington, Virginia. So I tried to do hard money, and that lender that we used said, oh, by the way, this was at the last second, said, yeah, it's outside our 200-mile radius or whatever from where we are located, but we can't do the loan. And literally almost lost the deal. They went to the bank in town and finally figured it out. But in certain rural areas, it's the only place to go.
Yeah.
You know, the local bank or to somebody that knows what they're doing like this. And if I didn't go through it myself, I would never have known because nobody talks about how complex these deals are.
Okie dokie. Yep.
Strategy and how it works.
You guys familiar?
Who are we talking to?
Anybody?
I don't do swap lending, so I'm not familiar with that.
Yeah. What's your question about it?
How it works and whether or not you guys use that strategy for your deals.
So it's not a strategy that a lender would use. It's a strategy you would use. But it's basically acquiring, if you've got property that you're selling, you keep your existing mortgage on it, and it's basically like a contract for deed scenario. I personally haven't done one, haven't seen one done in probably 12 years. But my guess is they're going to be coming back probably with a vengeance in the near future.
Yeah, it's really a creative finance strategy, particularly with subject to buying property subject to. You take over the ownership of the property, you leave the existing debt in place, and then you wrap that debt with your own loan.
That you're providing to the person.
That you're providing, you're covering your debt, and you're presumably cash flowing, $200, the original payment versus your new payment. A lot of people will structure it so that they collect a down payment up front. So let's say you're buying a property subject to, you've got to bring 20 grand to close it, maybe pay the seller some money, maybe pay some arrears or whatever. You need 20 grand. When you go find a buyer who maybe can't qualify for a conventional loan, and you say, hey, I'll get you into this place. I need 30 grand to close, and then your original payment's $1,500, your payment's $2 grand a month or $2,500 a month. You charge them up front. Maybe you collect something at closing, 10 grand in this scenario, and then you're cash flowing because you've then wrapped the existing debt with your own debt, which is servicing the original note and plus your cash flow. So that's like the concept behind a wrap. I don't know, Glenn, I don't know if you want to.
You're becoming the lender, essentially.
You need $100,000 in the deal. And I might have an investor who has $80,000. I'll bring in my $20,000. I'll pay my lazy money guy 10%, 8%, whatever works for them. And I will charge 2 or 3 points plus 12% on the whole load. So, but I'll take, for me, when I set them up, I'll take the first loss position. And I will tell my lazy money that this is the way, and we will put it in writing, that if there is a deal gone sour or bad, that I'll take the hit on it before anything comes to them. So it's protecting them a little bit. There's a bunch of different ways to do it. Mike was describing working with subject to.
Yep.
There's ways to do it that way too. So it's a broad concept and can be applied in lots of different ways. If you have questions, let me know a little later.
Yeah.
It's a very unique situation where you've got really cheap interest rate on your first lien, and interest rates are rising. So either you don't have a conventional loan, like someone said, maybe the borrower doesn't qualify. So it only really works in very unique situations, at least from what I know.
Yeah, sorry, I didn't know if we'd be able to get to wrap lending today. It's 7:30, so I want to make sure we've got some time for networking. But I don't know if anybody has any last second question. Yep.
Along those questions about a wrap, what about can DSCR be used for a second position loan? Say like a VA. Okay, never mind.
No, DSCR is only first position, as far as I know.
For what? What was your?
Like a VA loan assumable, so it close the gap between the cost and whatever's the debt on the VA loan.
An assumable VA loan?
Yeah.
No.
There are some private money lenders that will do second position liens, but
I mean, are you asking hard money is ever done in seconds or just DSCR?
DSCR.
Yeah, no, I don't know of any. I mean, I do seconds, not with Restoration Capital. I have another company that does seconds, but not DSCR. Yeah. Yeah.
You're talking about an assumption. Yeah. Any other last minute questions before we break?
Is to use your retirement accounts if they're self-directed, and you can use that small amount of money in your self-directed IRA to be that wrap money, and you can take, once again, the lazy money, and you can have an extraordinary return back into your retirement account or your Roth account. I can run some examples next time if you want to see, but it's a lot. It's good.
Yeah. Anytime you can use self-directed IRAs for real estate, it's usually a good thing. Cash flow is nice, but it's not taxed.
Okie doke. Well, Brian, Patrick, thank you guys. Awesome. Appreciate it.